you have a technical analysis organization, and this is definitely mother's milk for me. But I will say that I am much more interested in macro as a backdrop and then overlaying technical on top of everything I do. So I have a particular approach that weaves in intermarket analysis. And this is really what helps me identify directional moves, intensity of moves, and also the duration of those moves is my intermarket analysis, which I call my secret sauce. Also, this is a little bit beyond sector rotation, but I use sector rotation tremendously for market timing calls. And I will kind of give you a little overview of what I see and see if it resonates. You're welcome to ask questions, of course, during or after. And then just a little bit about me. I've got a whole financial research firm, so it's not just me. I started at, migrated, if you will, to adding some folks and elevating some clients into contributor status. And now, over the years, I've grown this so that I have a financial research firm from macro to micro, including a classical economist to Bob the oil trader, right up there in Halifax. Lots of technical analysts and also fundamental focus. But the point is, we are covering all assets and timeframes. We were just kind of talking about this before going live. I wish I could ask, every single person, what is your definition of time frame? Because it does matter. In my particular world, I do cover literally live in a trading room every single morning from a macro review of market moving news and the policies that impact price to the sectors and themes that are moving right down to the stock option analysis, quant, the whole thing. So I'm I'm a solid generalist. I'm not focusing on just fundamentals or macro or technical. I weave it all together. And I do it across time frames, chase, swing, and trend. So the chase is usually a lot of people think of this as day trading. I don't. It's several days to weeks. Swing is several weeks to months, and trends are several months to years. So if you consider yourself a position trader, you're probably a trend trader, for example, right? Anyway, I do run the live trading room for the thrill of the chase and to do custom engagement with my clients to cover anything. So I do have to kind of serve as a Bloomberg terminal. So there isn't really anything that I can't cover with my team live for clients. And then I write it all up. And none of it's AI, it's all original thought, but it is a very much a labor of love. And like I said, it is a team of uh, folks coming together and supporting clients. That is one service that I have, the main membership service at LaDucTrading.com, and you can check that out at your leisure. It also has kind of a rundown of folks on the team as well that I have worked with for years. And this is a fabulous group of folks that we make available to clients in for one price. So this is literally the value add. You're not paying for each individual. They're all stating their analysis and their trade setups in live portfolios with trade notifications, all within our Slack workspace. So you can check that out at your leisure. But this is what I do. Macro is a narrative to help predict market moves. Micro is the market structure to help position for the market moves, right? How to manifest that trade. And we translate all of that for clients. And then we populate it in the form of written analysis and portfolios. So there you go. The other hat that I wear is actually of a web app innovator, developer, investor. I have five fintech products, and one of them is this portfolio, but there are other tools that we're also bringing to market, which I've gotten really excited about because they fill the need for both retail and institutional. And I'll be talking about those in another time, but you'll find them on our website as we move forward if you're interested. And then basically, I wanted to go through and show you a little bit of how I look at the markets and then answer any questions that you might have. But I'll start by going kind of backwards, since especially you're in Canada and this natural resource mania has now trumped the AI mania. And I actually really was in front of this back in April of 2024. So August 5th, April 2024, I had a very strong focus of recommending this monster sector rotation play. And this was, I'll just show you right here, some of the charts that I came up with that are going to be a little bit unique to folks. Forgive this little interface here, but as I'm trying to do a screen share of some client posts, I want to share them for you. I mentioned this one in particular because it feeds so much. This migration into gold as, metal is the new oil, basically. That was a theme, and the whole focus of the macro reserve currency of hoarding gold at central bank level was the underlying or underpinning foundation. But there are so many macro reasons to stay long precious and industrial metals, and then how this will manifest in inflation, de-dollarization, and of course, that whole impact on equities. So long story short, this was a big, big, big monster sector rotation theme that I identified early in April of 2024. And I'm going to show you a particular technical analysis that I did on a chart that might surprise, but it was the foundation of feeling that this was going to be a monster move. So long story, fast forward, and gold has been not only the best performing asset on a 3-year look back, and that is over Bitcoin and SPY combined. But now we know what's happened with silver, right? It's moving 4 times as fast. And I had a particular gold silver ratio that I used very, very early. I want to show you. It's not really a ratio, it's actually a geometric mean, but it was an intermarket relationship that I had gleaned early on and I had been tracking, and I use every single day, that helped me stay very, very focused on this emerging theme. And then, of course, using macro as the backdrop to stay very front and center for clients on the gold, the silver, miners, that then, of course, spread into palladium and platinum. And I'll show you that as well. And then that spread into industrial metals of aluminum, copper, steel, and so forth. So this is what happens. Later, oil will have some impact, but I have been very oil bearish. And I want to show you that chart as well, where I posted last year. This is another thing. We're talking April, June of last year, how I was very bearish oil and bullish solar. So these are macro trends on the backside that are fused with my technical analysis, mostly in my intermarket view, which is cross asset correlation. I compare and I contrast different assets to determine which will lead. And so that's basically how I came up with this whole concept. But it always, always does help tremendously to have a macro backdrop. So for example, this is what I had written, by the way, in April of 2024. So this is almost 2 years ago. Foreign central banks will not stop converting US dollar for gold as long as the US is in fiscal dominance. Debasement of the dollar is bullish gold. Gold is at all-time highs nominally, but not relative to US dollar. It has room to move much higher relative to history. Central bankers need gold, not gold equities, to circumvent US dollar, but gold, silver stocks will appreciate nominally as the underlying prices rise. Gold and silver chasers will point to the $35 to $850 gold run during the 1970s, when stagflation occurred in the US during an inflationary wave. Investor expectations are currently extremely low for miners, which is a great setup for my mantra that outliers revert with velocity. So I think you can see that I'm framing this very much from a big picture, right, macro backdrop of the underlying currents that would support this rotation. And then I'm digging into, okay, I'm really bullish. I'm going to talk about this as a trend long. What are the stocks, or what are the reasons why, from a technical analysis part, I'm so bullish? Now I want to bring up a chart that I actually had shown, and it's kind of stacked here, but just kind of bear with me. All right, so I wrote in April of 2024, just a few days before that post I just showed you, that this was my most bullish chart And I literally review this chart every single morning. And I had been doing it since about November. Let me just kind of show you this bigger picture. Okay, there it is. All right, so this is not a gold silver ratio per se. And I'm sure many of you are familiar with ratio analysis, and this is not it. It is a geometric mean, and it helps to identify, for me anyway, patterns just like anything else. But big picture, it also helps me see when one of the other assets that I'm comparing, in this case, silver to gold, will outperform. And this is on a monthly time frame. So we're talking really zooming out. So when I'm looking for big, big, big trends, reflection, inflection changes, I'm going to zoom out to a monthly, then a weekly, then a daily. And then, of course, I'll do nitty gritty on an hourly chart. But this is where it really got interesting for me. Okay. So I started showing this chart in November because we had Fed pause and what I call the Yellen Yahtzee, which was also a macro intervention. So we had intervention policy where Yellen issuing shorter duration T-bills basically to finance the ever-growing deficit. And Fed basically came out and said they were going to stop their rate hike regime. And as you know, everything went higher. And it was very, very, very bullish. So long story short, we had a very nice rotation here that was forming in this analysis that I had of my stock, silver gold ratio. Now let's see what it did a little bit later. Okay. So I'm just kind of keeping you up with this, right? So this is still my most bullish chart updated. Here's that inverse head and shoulders. I'm talking on a freaking monthly, right? How many people day trade and lose the meat of a massive monster trend trade is sad to me. So this is why I'm showing you this secret sauce. All right. So we broke out higher in March, by the way, in gold. That was in 2024. And the next month, silver had spring loaded, right? Gold always leads, but then silver spring loaded went up 10% in a week. It was a massive outperformance, and I'm like, okay, we're off to the races. So let's keep building this chart because it's fun. Let me show you how my mind works. I think this lady's crazy, but I don't care. It works, and it works especially for clients because this is what I shared with them and what I show them every single morning. So here's the next one. Let's fast forward to about September of 2024. You can still see this beautiful formation, and now we've cleared some levels all the way back from the drama of COVID when we had the COVID crash. Gold spikes higher, and then it's a collateral trade, it's sold off, but basically it has a long digestion period and then it goes very strongly again. So I knew this thing was in play. So we are here today, which is basically pointing to the 2011 highs. You all remember that too, I'm sure. All right, so we're building on this chart, and I'm going to just kind of keep going here because you're going to see it until we get to the point where, oh, I might have fast forwarded a little bit faster. Anyway, we're going to get to the point where recently I showed clients that we were getting very extended. So then this is the chart many months later. There's some in between, but the point is this is what it looked like where I just showed it to you deeper down, right? And this is when it broke out in March and April of 2024, and you can see what's happened. Now, I threw a fib analysis on here just to give some ideas of when we would get some digestion. And one of those times actually was in October. So back in October, I had gotten a little bit nervous that we were going to get, it was going too much too soon. And this was a metal squeeze post that I had written. And I literally said, careful, we got a metal squeeze and it's forming a funding stress, which is a rotation into dollar, the US dollar. That timed really well when I saw breadth was weakening. This was in September, I started warning, and then October, I'm getting very, very cautious because we've just moved too much. So the dollar bounced on Q, metals dumped. Okay, gold and silver, big picture. I showed some of these key charts, and then I started to basically warn in September that it had gotten too much too soon. So what were the levels that I was looking at? For example, the dollar, this is on a 2-hour chart, was starting to move higher. So I was looking for a particular technical level to assess some incoming danger for gold. But this was really the chart that did it for me. So again, I don't know how geeky some of you are, but you're going to love this one if you trade metals. This is the gold miners bullish percent index. So I put this on a big picture and I'll make it bigger so you can take a look. But basically, gold has typically, there we go. No, it's not showing up. Has typically, I'm trying to see if I can get it a little bit bigger for you, had seasonal volatility in October timeframe. And this particular chart had a very clear defined, let me see if I can make it really big. There we go. It had a defined top. So this is basically an oscillator and it cannot get above 100. It had gotten above and into 100, not above, back in the October 2016 timeframe before a very strong crash into 2015. The next time it triggered 100, which means it can't go higher, was in August of 2020. And then we underwent a digestion period. And then the third time was as it was approaching, and I was warning September 20th. I said, be careful for October, because this is when we have had some outsized gold volatility in the past. So I literally was on a show, like just not very many days later. And I talked about how I was very bullish, big picture gold, silver, and industrial metals, but that it was time. It was time to protect gold. And the very next few days, it just dumped. And we had a 5 standard deviation move lower in gold. So that's a timing trigger of warning to let clients know that we have volatility coming in, but it's not what do you call it? A warning to close the trend long gold and silver or platinum and palladium. It's just that we're going to have some outsized volatility, and we did. So speaking actually of palladium and platinum, I also like to zoom out on a bigger picture. I've got clients that are very invested in commodities, and I was not bullish oil, but I was very bullish all of the precious metals and industrial metals because they follow. So you can see this palladium. I've got one here that's also on for platinum. They were starting to come in underneath this kind of 2024 crossover that I showed you with gold and silver, but the price action really wasn't doing too much. Well, you know what's happening now, right? We've got this nice resurgence higher in lots of palladium stocks. We have an outsized move, very much so, in platinum. So when this triggered, also a technical test, by the way, of okay, when we are oversold, it stays oversold. We start to move higher. It runs. It's a beautiful scoop pattern. It's above zero. And now look at this outsized move that has just transformed everyone's view of the commodity cycle. And this is what I'm kind of trying to point out, that I look first and foremost on a monthly time frame before I do anything else. And then I look at the macro considerations before I do any real, recommendation on an investment time frame. I hope that makes some sense. So here's the most updated kind of look on the gold and silver intermarket view that I use as a backdrop for my market timing calls, big picture on macro trends. Okay, so we're talking about my oil short, my metals are the new oil, long, and as it relates to gold, silver, platinum, palladium, you get the idea. And then I can apply the same overlay, right? Supply deficit, commodities, trade wars, for sure, and not just rare earth, critical minerals, precious and industrial, all of that stuff. And I can also dismiss oil as a theme because my intermarket has been so strong in showing me the weakness. So not to get excited or not to recommend oil to clients. So sometimes it's just as powerful or profitable to stay away, get your money where it's most, productive, and stay away from the areas where it's not. There have been better things to trade than oil and oil related stocks. Full stop. Anyway, this is another intermarket tell, and I'm sure, many use gold SPX as a ratio. And I know, excuse me, it's very hard to translate that into a durable theme, but I did. So I saw this bottoming, as I showed you already, with the gold, thesis and my funky little geometric mean chart, et cetera, and technical analysis and gold miner percent index, all that stuff. I can show you these funky tells that I use that are intermarket. It's just a language I strangely understand. But this is something that tells me the move is not done. So here we are. This is December 22nd. And not only is this a beautiful, basing formation, gold relative to SPY. SPY, as you know, the S&P has a massive concentration risk, right, in the AI mania, but the Mag 7 tech wonders of the world. But gold has outperformed. Full stop. I won't even talk about, silver right now in that context. But this little ratio right here, 0.65, has been tagged before. Back in 2015, 16, 2020. It did actually hit in 2025, but it didn't close on the weekly. It came back down before the close of the week. Anyway, I tracked this stuff. And now we're getting above it. So, what does this ratio next look like? If you're a technical analyst and you're like, okay, it spent a lot of time over the years trying to get this ratio back above 0.65 as the trigger, 0.85 is the most logical. We'll hit 75, of course, then on our way to 0.85. What is this ratio of gold to SPX telling me price will be for gold? About 6,000. So I'm able to kind of extrapolate some of these wild and woolly moves, which, by the way, this particular, as I mentioned, geometric mean of silver and gold on a monthly is showing me that silver is outrunning gold 4 times. It's moving. In other words, silver is moving 4 times as fast as gold. But gold is what central banks hoard. Gold is what China is settling trade in outside of the US dollar, US treasuries, and US petrodollar. So this is telling me gold has more to go. Long story short. So even with rebalancing that's going on this week, with Bloomberg Commodity Index, even with margin increases, which have been increasing, this is still telling me it's on a trajectory for higher. It won't be in a straight line necessarily, but it's still bid. I hope that makes some sense. All right, so here's an example of why I wasn't bullish. The oil patch. All right, so here's a chart again on a monthly. I'm kind of fond of zooming out, right? Big picture. Folks I know are very invested in oil for all kinds of reasons. It makes the world go round, no question about it. But I'm not married to any particular theme. I want to lawyer the trade, bullish and bearish, and see what's going on, right? I have a very strong thesis about gold, silver, miners, etc., precious and industrial metals, metals as the new oil. I am very strong thesis that long stocks equals short dollar. In other words, the US dollar debasement, de-dollarization, devaluation. That was a big picture of mine going into 2025, and I think it can continue. Why am I not bullish oil? Because one of the reasons is because this chart that I have been tracking for a good long while, let me just show you, a good long while, has been falling beautifully, even with a simple MACD rollover. So I'm talking once we got back inside, and I had written this up last spring, so quite a while ago, as it relates to, nope, I'm still not bullish oil. Nope. This happened to be an update in September just to kind of show you that we had broken inside this trend line, and I believed firmly we were going to head back and get and stay below 65, and we would have a new range. So my call was that we would fall in the $60 to $40 range by the end of 2025. So obviously that's more than a year ago, right? That I have this image of a monthly chart of crude, but it was actually June of 2024 when I predicted we would fall into 60 to 40 in the crude handle, and we have tagged 56 several times. So we're firmly in process. Let's just put it that way. But the reason I heighten this is because there's also a macro trigger behind it. We have falling global oil demand, and I know you won't, many, will take issue with that, but it's true. China has mandated this electrification, right? Ground transportation vehicles are no longer, bought as ICE or internal combustion, but electric. And 50% of vehicles now in China are electric, 30% in Europe. There's more of a migration for sure in India and South America. Even Canada's allowing them in. US is very slow. We only have, 10% of vehicles are EV. But my point is, there is falling global demand for oil, and that is affecting the price of oil. So I had the macro theme. I just needed to kind of stick with it. And you can see this is, just last December, how price is still coming inside. We've tagged and gotten a little supported by 56, but I don't think it's going to be very long before we actually fall further. And that is, again, a macro theme supported by technical analysis. And every time we get a spike higher, let's say Iran Israel escalation back in June of last year, it's a short the rip. As soon as the event is done, oil goes right back into its new lower range. So that was basically kind of a first and foremost of how I viewed this theme of, okay, commodities, metals of the new oil, long stocks equals short dollar is kind of another thesis that I have been stuck on, and it's been working really, really well. And it also is supportive for commodities. It's also supportive for inflation, even if we don't see it yet. So it's going to make it very, very hard for the Fed to cut aggressively. One, if they don't have consensus, but two, if they don't have a weakening, economy, but they have sticky inflation. And I think that's more like we're going to continue to see. So this US dollar debasement theme is very, very helpful for also value, which is my next little area I wanted to talk about, since we've gotten and pushed into this theme here of, one second, I want to show you right here, of equities on falling dollar. This is a post that I had given back in July of 2025, and I basically followed it up with this particular intermarket review. So let me just show you that first. This is my intermarket review in July. I said, okay, SSCC, China, Shanghai is bullish, and a parabola can result. The NASDAQ composite is bullish until we get some credit spreads, but they're not moving higher. Gold is consolidating before the next big push. Boy, did it, right? Anyway, so we have this theme that I'm presenting here that was very basic, that dollar would continue to be soft, and the dollar falling would help equities rise. So if 6,100, I said we'll head up to 6,500, 7,000. As you know, we're there. And if 7,000, we're talking 2026 now, because this was, in summer of last year. If 7,000, just on a fib retracement level alone, we could move higher into 8,200. Now, I know folks are going to say, no, 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 no. But consensus actually is in the 77, 7,800 for 2026. And we know what happens if a dollar falls quickly. Market can get a little manic. We also know that they are incentivized at the White House, the Fed, the Treasury, Congress to keep things moving along, right? So there is a potential, especially on falling dollar, of a move higher into 8,200. I don't think it's going to be easy, but there's absolutely a technical potential of moving higher this year. So I'm not so bearish until I can see a rotation and breadth destruction and actual selling. So let me show you what that looks like in my little world. Okay. So right now, this is some of the stuff that I go over every day. And that is, oops, that's not what I wanted right here. Okay. So this is the idea that I have of showing clients every single day. Okay, what do I see? Like now that I've just given you big picture, big picture. Also yield curve steepener was one of my 2025 calls. and a bunch of other stocks, specifically in the space sector. But I don't think I care so much about that. What do I do every single day? What's my kind of morning routine besides checking in on oil and dollar and yields? I'm really focused on this analysis. Let me kind of show you what it looks like. Because I just kind of gave you an idea that ratio analysis is very helpful, and I focus on breadth and buying and rate differentials. So every time I type that, it goes on the next one. Sorry about that. So breadth buying and rate differentials plus this growth value rotation. I deem it source of funds. What does that mean? Folks are always talking about how, growth is outperforming. Yes, yes, it does. But then when we have a rotation like we've had since November into value, they're like, hey, market's doing fine. It's broadening out. The problem is that oftentimes these themes can go a lot longer than expected, where the value, large cap value, take a General Mills or a Campbell's Soup or whatever, it doesn't have any of the excitement, right? It's not touching the AI or the tech sector moat. And so they fund the high flying growth sectors, the semis, the AI, the space, etc. Then, when that narrative starts to falter or fade or pause or consolidate, they rotate into value. And I have a particular chart that I use every single day for that. And it is what helps me stay on the right side of what theme is moving in order to trade it. So let me kind of show you what I mean. Here is this most recent? Close enough. It's yesterday. All right. So here's the growth value ratio. It's really simple. I mean, this one's really simple. There's no geometric mean. There's nothing difficult about this whatsoever. It is literally the Russell 1000 growth, and you're comparing it to the Russell 1000 value. So I'm not using 2000, I'm using 1000. But the point is, when this is outperforming, Nvidia is doing great. These semis are doing great. You want to chase, you just want to chase tech. It's a waste of money if you're chasing value, because large cap, consumer cyclical, industrials, metals and mining for the most part, because they're sucking wind. And then they have these outlier events, just like we had back in July of 2025, before the yen carry trade unwind, where the market crashed a good 15% in NASDAQ, 25% in NVIDIA in 1 month, that type of thing. Or this particular year where Trump comes into office and we know we're going to get tariffs and the market's getting really skittish and the dollar is falling with equities, and we have a growth risk. So they're de-risking growth. Okay. So just recently, I made this call, pretty simple if you can look at this technical line, right? This very, very simple trend line. I said, if we get back inside 2.3, that's the ratio over here, we're going to have value pickup. And in fact, I think we're going to have consumer cyclical value pickup. And it's going to be awesome, like the Dollar Generals and the stuff that's been left for dead. It has been a fabulous rotation, and it's still in play. So as this indicator is falling, it doesn't mean that growth necessarily is giving up the ghost. It's not crashing, but it's soft. Gravity has taken hold and it's just not getting bid. So what are the things that I mean by value rotation? So let me just show you if I can find my notes from my update. Okay, so here's an example. January 7th, these were swing shorts. Okay, you got the usual suspects here. Growth, in other words, is taking a break. So these are tradable themes, very strongly tradable themes for short duration. Apple, fell from 285 all the way to 260, and I believe the next price target, it's not if, but when, is 253, that type of thing. Netflix worked great from 121 to 90.80. Palantir, Tesla, and App all had weekly gaps down that we caught. Hood, SoFi, they're soft as well. AMD had a fabulous breakdown. Oracle had a fabulous breakdown. The point is, you can chase some of these stocks that are in the growth sector short, and then you can have at it for going on value rotation longs. Some of the longs, by the way, may be already near all-time highs, and they may already have a theme, right? Like Lockheed, General Dynamics, Textron, fabulous. Or they could be oversold, left for dead, UPS, Nike. These are incredibly successful since November. The point is, and not just them, Constellation, Public Storage, International Paper, they're coming up off the bottom. Colgate, I mean, crazy. Philip Morris, stuff that had been basically consolidating and not moving are now starting to move higher. And this was an update just yesterday. So on Monday, you can see that I'm not even focused on tech shorts anymore. I'm totally focused on a beautiful array of longs that are in this value rotation from ODFL, which is Old Dominion, oops, a trucking name. And I mean, I can show you technically any of these. They're not just a particular sector rotation like industrial metals, right? Um, this is what I mean by source of funds and why I put it that way. It's not just money flow. It's very important because when you have forced selling in the XLP, let's just say consumer statement staples, you have buying in XLK, which is tech. In this particular case, tech has been taking a back seat while the consumer cyclical rotation since November has been in full swing. And these are names that are very tradable on a short duration. So I can show you, for example, how that looks from a quant standpoint, where tough start to 2026, right? This is my consumer cyclical rotation theme. The S&P underperformed the Russell by the widest margin since November of 2024. That type of thing. So this is where we have an advantage by studying technicals that may not be everyone's usual suspect, but that's exactly how I do it. So I'm using sector rotation as a way to time the market direction, which in this case is sideways because tech is taking a back seat. The duration, well, once we get a bounce, we're going to have a nice growth bounce again. But how much likely, in other words, how durable is that bounce when it's so weak right now? So I basically gave the timing of this consumer cyclical rotation until February. So we've been trading this November, December, January so far, and I think it's going to start to peter out in February, and then there'll be better names to trade. But that's a look. Maybe it helps. I also do a lot of work in sizing up quants, and I use technical analysis as well. For example, this is CTAs. They're price insensitive buyers, and they came in on that April low, and basically you can see how strong they were. Then they petered out back in August, September. And if you notice, the market also did. And now they haven't sold aggressively. Buyers have not stepped in, and sellers have not stepped in. There's kind of a equally weighted balance of the market going on right now. But if we see the CTA position come back down below this zero mark, we're going to get some more forced selling or de-risking. So these are some of the things that I look at every day from the big picture, on in to a 2 hour time frame. This is China rotation, by the way. So when you saw my note in June, July of last year, and then most recently, I said, wait for the next burst in January. Sure enough, this is the Shanghai Stock Exchange. Very strong rotation you can see on a monthly. And it happens. There are triggers sometimes. That was the yuan devaluation that caused a parabolic rise. But right now, there's an AI rotation. And stocks over there are doing gangbusters. So the point is, there's always a rotation somewhere. I am still sizing up a large value, large cap value rotation that's still in place, and it could get very busy. This is the last one I want to show you for those, again, who are really into the ratio analysis or intermarket. This is actually the small cap 600. It's not the 2000, which has 43% of its constituents are unprofitable. right? So you want to get with a higher quality small cap index, you go with the S&P 600. Look at this rotation out, right? On this ratio of SML to SPX, and it's coming to an inflection point. Do I think it's going to pop above? I actually do. Why? Because I've seen this guy before. Now this is large cap value relative to large cap growth. And right now, price is fine. We're right back up to the December highs, but this ratio looks like it's about to get busy. Now look at XME, just as an example, with this ratio. Look at this ratio of down here, XME to SPX. XME, as you know, is a lot of metals and mining, right? Not just gold and silver miners, it's copper, it's coal, it's got lots of stuff. Now look at what happened. We triggered above in July. And what happened? Oh my goodness. Little pullback. Oh my goodness. This is XME. So when I'm sizing up ratio analysis, it's this type of thing. I'm looking for an inflection point, and this was outperformance, right? This was the April low, and then it really didn't technically confirm until it could get back above its prior breakout area in the 65-70 area. And now look at it, it's 120. So these are the types of technical reviews that I do from a very big picture and cross asset rotation type of view that helps me, for, kind of time not only market direction and changes in the market, but also the duration and the intensity of the change. So otherwise, there are some things that I use that are reviewed every morning with clients. I've got a lot of breadth indicators that I actually use on an intraday time frame for timing turns intraday, all the way out to, of course, bigger picture, yen carry trade unwind type of stuff. But I do a lot of work in studying breadth across assets and buying. And I don't mean just retail buying, but like I showed you, there's quant positioning, there's fund positioning, there's literally net volume that you can study on your index or sector that tells you if there are more buyers than sellers. And that is a really great source of timing turns because I see the air pocket of risk that can form underneath the market. So in other words, they come in and they sell before the price action actually manifests itself. And it actually can take weeks before you get a drawdown of size. So I also study the option market very closely. I'm very fortunate that I have a contributor who is a quant expert and has some fabulous tools as well. So I'm really blessed that I get to work with a bunch of folks that have skill sets that are outside of my particular focus. Mine happens to be intermarket analysis and then overlaying macro and technical and then pulling in fundamental and quant and putting this all together and coming up with durable macro trends, sector rotations, and then within the sectors, picking the strongest names. And I hope that gives you a little idea or overview of how I look at the market. And last but not least, this is very important, and this is a mantra of mine. In lieu of sector rotation, there will be volatility. We have sector rotation right now. That's a beautiful thing. It's very profitable. When it's done, there will be a currency rate or equity volatility that reprices everything. So right now, we don't have a lot of currency volatility at all. We don't have a lot of rate volatility. We need currency and then rate volatility to trigger equity volatility. And that reprices both growth and value. So that's my mantra. That's how I view the market. And that gives you a little idea of what I am currently trading as well, which is the large cap value and commodity consumer a cyclical rotation. And I'm waiting for the next bounce in growth. So I know what I want to get when we get that rotation underway. I've got that lined up and I share it all with clients all day long.
A lot of information there. One thing that I'm going to ask, I certainly didn't get into the silver and gold as early as you did, but there's a lot of the memories
But
have
you
developed
got it.
from,
That's all that matters.
yeah. Yeah, I did get in onto it. So I was going to ask, I haven't had a chance recently to track. but I know there's been some, and you mentioned it, increases in the margin requirements. How much has there been, and how much do you think they're going to continue with that silver problems?
Well, that's very specific to, I don't call it silver problems. I actually think that this is just market has gotten a little ahead of its skis and they're trying to put some order into it, but it's away from reasons why silver would actually pull back. The only reasons, in other words, for this rotation, they've just made it marginal as it relates to a percentage wise, but it's not going to slow things down. So the only reason why silver, gold, what have you, particularly the silver, would pull back is if we get some scared longs, right? The last in, are the first out typically, or we get minor interruptions. But rebalancing hasn't made an impact. Even the margin increases haven't made an impact. We had a little dollar pop, like I said, I saw that coming in September and I warned about it for October. And we had a very large 5 standard deviation move in gold, but it got bid back up. One thing that I would warn about, even more powerful than margins, margin balances and increases, are things like the yen intervention. So as the dollar yen continues to push up past 158 to 160, 161, at some point, Bank of Japan is going to come in, do an intervention. And I have found very often that yen and bonds, US bonds like the 10-year, will bounce and that will interrupt the metal advance. Another thing that I have found is that VIX always interrupts the metal advance. So let me show you what I mean by that right here. Um, and also a currency changes, rate differentials have a big impact. So here's another reason. This is the dollar yuan, and you can see April intervention on this, April marker. You can also see April intervention overlaid with silver futures. So as this is falling, you can see that silver is outperforming that type of thing. If the yen carry trade comes in, I'm sorry, Bank of Japan comes in to do a yen intervention that will have a pop in NDX selling, which means a pop in VIX. But those are short. Those are short duration, shake and bake type of moves. A more durable reason to short silver would be rate hikes. A more durable reason would be reversal of trade wars or peace or, political stability in the US. The only, repeat, the only macro reason to short gold and silver at this stage is surplus, which we don't have, or a balanced budget, which we most certainly don't have. That's it. So, from a macro standpoint, that's it. Now, you will have interruptions along the way, right? Scared longs, yen intervention, VIX pops. But VIX is, by the way, meant to be shorted. So it's a reversion trade. It will always go back down. So the point is a more durable reason is going to be rate hikes. And we need to have a little bit more time for that to be in the playbook. And right now, Trump is very, very concerted effort to control the Fed and monetary policy. But with inflation, with all these metals, et cetera, then we're going to have inflation later. So it is a potential that rate hikes come into play, but it's not a high probability right now. So I would say this is a stampede. I called it the silver stampede. It represents a growing chorus of consensus in lack of faith in the US dollar, collateral, which is treasuries. Bonds have been terribly performing, right? US leadership, it's a lack of faith and de-dollarization trend that also then meets this inelastic supply, which is meeting an unquestionable thirst or for demand. So I think right now we have a lots and lots and lots of room to go, but it will not be smooth. And we've already reached all my price targets, so now I have to come up with other price targets. This is really the challenge. But this is one of the forms that I, view, which is, as you can see, because I have to come up with other things. These charts have just become unwieldy, incredibly extended. So,
We had a question come in. What are your opinions on the financial sector? Things like banks and credit cards.
banks have done really, really well for a main reason. They love it cheap and steep. And I'm talking about the 10 and 2 year yield curve. So if you can see back down here, this time frame, we're actually um, moving higher. See, this is all technical analysis, fake breakdown, and then reversal. And here's your zero line. That's really, really critical when the yield curve, I'm talking 10-year, 2 year, got back above zero. Very important. And here we are. We had actually a few momentous occasions. We had the first rate cut back in September of 2024, and it was a surprise 50 basis point rate cut. Anyway, the point is, we also had it retest the zero line. Beautiful breakout higher, beautiful breakout higher. This was the shake and bake of April 2025 after the tariff terrors when the credit market seized and the U.S. equities market dumped, right? The whole thing. Yields also spiked lower, et cetera, et cetera. So this was 0.64. And by the way, on December 12th of 2024, I said we are now above zero. We're going to stay above zero and we're going to move to positive 90 basis points. And by the way, getting to your point about banks. So banks love this. So this is really good for their net interest. They are crushing it. Now, JP Morgan came out today with earnings and it was sold off. There's a lot of buy the rumors, sell the news. It's been run up. We also have this rotation that's been holding the market very firmly, which is growth and banks on promises of economic expansion, et cetera. But I would say the number one reason is this cheap and steep. They absolutely love it. Look at Citibank performance. But the problem is the debate of whether this will continue. I feel strongly it will continue into my 90 positive basis points. But if it's going to be a bear steepener or a bull steeper, and we can debate that, but that will determine more of the performance on financials. So long story short, they haven't done anything wrong yet. They haven't broken trend yet, but we have to watch this steepener as a tell. Bitcoin, I look at this one all the time as well. Or you like the use of growth to value ratios. This approach is new. And you then overlay your technical analysis, right? Just like I overlaid the yield curve with technical analysis, right? So anyway, Bitcoin, that's my growth value ratio, still over, trying to work itself out here, not ready for a tech bounce just yet. But Bitcoin is a liquidity tell. So I do watch Bitcoin very closely with Ethereum, and not only because some clients are very much into it, but because it's a liquidity tell. So we do have liquidity in the market, by the way, no question. But money has been sucked out of Bitcoin to go chase gold and silver in a nutshell. So can this move higher? It already has above, 95, pushing into 100, 105, but it has rolled over of size. So it's just kind of languishing here. There isn't really a lot of momentum. Same thing with Ethereum. It would have to get back above this huge multi-year wedge to be of any interest. And I don't really have any excitement here. It's also more of a currency than commodity. So I disagree that it's not a means of exchange. It's not used in the production of goods and services. Nope, it's a speculative asset at best, all tied to tethered stable coins and the whole crypto, universe of basically treasury demand needs supply needs to meet demand, and so it's basically an off ramp for those tools. I'm not a fan. Anyway, the point is, I don't have a lot of excitement about this. When it moves, it typically has a durable breakout, but I don't see that right now. Unless we have a solid rotation out of gold back into Bitcoin, that can happen. But I don't, um, central banks don't hoard, don't use Bitcoin as a reserve currency. So gold is the number one reserve currency over dollars. And even over euros. I mean, even over euros and even over dollars. So I don't think that's going to change. Yeah, so I definitely my call on Bitcoin is that it kind of comes up and peters out and rolls over, and probably we're going to see this. No, actually my call is we're going to see 65,000 by summer. I'm also a dollar bear, but Trump is trying to calm the rate of change at which the dollar falls. What are your thoughts on industrials? They like Caterpillar has already done amazing work, but are you talking about XLI or Caterpillar? For example, Caterpillar looks like a gold miner, a silver miner. Look at this thing because it's used so much in the build out of this industrial renaissance that we're supposed to be having in the US. It's very focused on data centers. Okay, but also gold and silver miners and all of that. So this theme, in addition of US as venture capitalist, right? That they invest in an MP. I have a whole list of companies that the US has invested in. This is also important to keep in mind that a lot of these companies have maybe a wheelbarrow full of actual minerals or rare earths, or they have got to be developed. So when this popped up right here on July the 10th of 2025, because the Department of Defense took a 40% position in this very small player, but the only player in the US, which was partially Chinese owned, and Chamath also had a 10% stake. Anyway, the point is, this is driving a lot of the speculation also in Caterpillar. But big picture, XLI has a lot of good stuff in there and it looks really durable. There's no question. If I go through the list here and I sort XLI, which I'm on a weekly, by the way, just because that's how I think. This is a daily, this is a hourly. You got, big industrials, including Raytheon, solid trend long. Of course, it's in the aerospace sector. Boeing, one of my favorites, and only recently has it gotten back above. Just look at this stunning monthly support, right? Monthly support. It pulled back a little bit more aggressively than I liked, but then it got back above 197 monthly, pushed perfectly into my 215, 225, 220, 244, 45 now. Little shake and bake back to 225 wouldn't surprise me. It bases here for a little while and then it moves back up into 260 and there's your wedge breakout. So industrials have a lot of appeal to me, if truth be told. GEV is a little bit different. It's, data center build out, and Trump is very bullish, etc. So we could go on. LMT industrials. LMT has not been above this 508 for such a long time. It's a beautiful thing to see. Anyway, you can see what's happening with industrials that also have aerospace, defense, and metals and mining and data center plays, etc. 3M, are you going to replace any of the work that they do? I love this one. Look at this beautiful bottom fishing play. This is what I mean by source of funds. It sells off aggressively. They go and chase AI mania stocks, but you cannot replace these industrials. I mean, the cost of building new manufacturing facilities to do what these companies do is cost prohibitive. So yes, I guess to answer the story is they're very good inflation proxies, and the stocks don't look bad either.
Well,
Samantha, in regards to China and silver, the government added like a tax or more forms, I guess, bureaucracy to get it out of the country. Do you see that as affecting cost of silver at all?
You have such a bifurcated market between US and China is the price setter of silver now. I'm looking for my silver chart, but I can't seem to find it handy. So I think that is depends on how you trade it. Do you trade via, for example, IBKR and Hong Kong? And they're doing lots of new issues, by the way, in the mining sector as well as AI. Here we're just doing AI and Bitcoin mining stuff. But I think that this is um, bears watching if you are under a capital control in China. But if you are in the US and you have a store of value in precious metals because of what's happening between US and China, there are very few alternatives. Like it's a really um, small market of safety plays. So I think that the margin changes here in the States, as well as what China is doing to tap down the export of not just refined rare earths, critical minerals, but also their precious metals, is part and parcel of the trade war and why we are going to continue to see support in these prices. I honestly think that, and it didn't really occur to me, honestly, until I had seen what happened with the prices of, for example, silver US dollar. I had in June, remember that post I just showed you, right? That we were coming out of June of 2025 and it was July. And I said, we've been consolidating. It's time for a breakout in gold and silver. And it pulled back in October. Hopefully you can see that. That was a, right? No way did I see this coming so quickly, right? I've got a fib level overlaid on this silver US dollar. It's heading to 98, right? It's well extended above the mean. There's no question about it. And this is not an ETF, a triple leveraged ETF. So the fact that this is just going parabolic on a weekly, just going parabolic on a weekly means that there's going to be a lot of volatility in the metals. And it will probably be introduced by China. Like they're selling copper right now to buy oil. Why? Because they set the price on copper. They don't for oil. So this is not an easy answer, but I do think that we could see, 150 in silver. And I already gave you my math equation for gold to hit 6,000 and this year. And I didn't have those last year, by the way. Nope, nope, nope. I had to, update my analysis. I have to see how it's performing. This breakout I saw, perfect 127 fib extension, pullback was shallow, and then it took off again in November. And it's following very, very tightly to the 10 EMA, which is very, very bullish trend. But now it's getting extended. So we will start to see some volatility coming in. There's no question. I don't know what the trigger will be to answer your question.
All right, we've got one last question. Scott asked, what is your outlook for platinum?
This small market that has just exploded. I was a big uranium bull back in November of 2020, and uranium has also outperformed. But there are so many vehicles to trade now, the uranium space, the CCJs, the URAs, the URNMs, the SMRs, because, even if you wanted to, the Oakland, even stuff that is tertiary, the data centers. But for palladium and platinum, it's such a small market and they're used, I know, for substitutes, but they get like they get like this. Like this is on a monthly. The platinum. Did you ask about platinum or palladium?
He was
Doesn't
looking at
matter.
platinum, yeah.
Yeah, they are just scalded, and I think that this is going to be another example of a parabola that traps longs. Now, parabolas are trapped longs. I know people don't understand that. It's not shorts. This is not caused by, short covering. This is FOMO. This is, oh my God, we have a supply issue and metals are ramping and it's an inflationary proxy and we have a trade war and we have industrial use for all these things, right? So this is retail with central bank, with industrial, with investors, all crowding into a $2.5 billion market. It's crazy. So very dangerous. I think it did a fabulous time of consolidating for many years sideways, and then it just broke out like a scalded cat, and now it will have a catch-up period or a catch-down period. It's very hard to chase these when they become parabolic. At least, palladium is more proper. It's slower. It has, by the way, this is anyone know Martin Kring? Martin Pring. So he's my kind of intermarket analyst, the godfather. If you've read his books or follow his stuff, this is actually his indicator. And it's very helpful when you put it on longer time frames. But you can see where a market that starts going in 1997 for palladium behaves and it stays bid, might come back a little bit, but it's still above zero. And then several years later, it comes back down and breaks the moving average. That's when you don't want to be in, right? You want to be cautious. Okay, so you can do this again and again using what I've just shown you. When it either crosses over or gets above zero, okay, it didn't fall apart, but didn't do really anything too outstanding, but it's still bullish. Same thing. Okay, nice run, beautiful run, and then it comes back in. I'm showing you just kind of an idea of how the trend can stay a long time. That was 2016 to 2020, right? So this is a beautiful scoop pattern. It's just come out above zero, and it's forming also a beautiful scoop pattern. This has a lot more room to go. This one has a lot more room to go. Might hit a little bit of a digestion here. You can see that trend line, right? But we've gotten above this, everything. So to me, platinum is scalded cat parabola. Be careful. It's going to have to do a little bit of shake and bake here. Palladium is just coming up out of oversold, even if it's taken a year and a half, and it's just coming back above, 2023 prices and has room to go. Does that help?
Certainly does. Certainly does.
Blair, I'd like to ask a little quick question. Uh, Sam, where did you learn all this? Like what?
Listening to folks like you. Like I absorb information that is very off, not off, that's not the right word. Non-consensus. Maybe even untraditional, I don't even know, but like I will take a rate differential. Let me show you. And I use it as hold on, I got to show you this. This is so cool. Like I came up with this and I have to test it and see if it works. And then I'm like, oh my God, it works. And then I start tracking it every single day like this. Okay. What on earth is this channel on a 2 hour mark? This is a rate differential. Somewhere in my travels, I saw somebody use this. I couldn't tell you where. The Martin Pring stuff, I know. I know all of this stuff. But this is 30, the Dow Jones 30 with the Japanese 30-year, right? So I'm doing a US Japan rate spread differential. Okay. Now it's choppy, but you can see how this thing is still moving up. This
in
is
that channel?
supported market. Huh?
In that channel.
In that channel.
Yeah.
So there are times where I have warned clients, I'm not kidding you, or not warned, that's a wrong word, but if we get, I'm like, okay, be careful. The market is probably going to soften a little bit, right? We've had an excursion in my rate spread differential. Now, oh, wait a minute. We just came down to the channel. We formed an inverse head and shoulders. We should start to move higher. And that was 1125. And so now this is what it looks like now. This
Well,
was that head.
I just
And
wanted
now,
to say
yeah. So
this
I
is
use
one of the most
everything.
spectacular presentations we've ever had.
No,
I,
that's silly. That's
no,
too
no,
much.
I've never seen anybody put it as well together, concisely, and with reasoning like you have. It's been really spectacular, and
Oh, thank
I
you.
um I think Blair, we should give her an opportunity to sell her services here.
I did at the beginning. You
Well,
can find me at LaDuc Trading, and I do this wonky intermarket stuff,
okay.
big picture. And sometimes it is, hard for folks that just want a trade because I like to come up with the rationale of why things are moving, not just what's moving. But anyway, I'm glad that you appreciate it. Very much glad that you appreciate it. And of course, I'm happy to answer any questions, and you can find me at LaDuc Trading at samanthaladuc.com as a Substack. That's a mini me, by the way. I got a whole team of 10 plus trading tools plus trading portfolios. I'm at Samantha LaDuc on X, which is mostly my macro. And then, of course, happy to work with you, talk with you, and very glad if this added any value.
Well, it certainly has. It's been very enjoyable. And yeah, I have to say that my youngest daughter is named Samantha as well, so it doesn't hurt to have a good name.
You'll remember me then.
I
I
certainly will.
appreciate it. Thank you
This
so
is
much, Blair,
definitely
for
a cut above.
well, I don't know what you're used to, but this is how I view the world.
It's a very unique perspective. And by the way, I'm offended at Faye. She said that we have some 1 hour traders. She was aiming that at me. I've gone down as low as 7 minutes.
That's okay. That's okay. But you got to zoom out and see the world sometimes too. But again, I'm very, very grateful for the feedback. And like I said, I hope it adds some value. It's a little quirky, but it works. All I can say is combine patterns on bigger time frames, and you will just be like amazed of what you see. Is, I guess, like when I saw, one more, when I saw this NASDAQ composite ratio relative to SPX starting to form a head and shoulders. And I went on Stock Charts TV when everybody else was very bullish in November of 2021, December of 2021, right before the rollover. I said, nope, market NASDAQ is going to fall. Energy is going to outperform in a sector rotation. What helped me with that, and I literally gave a 20% pullback for 2022 on a January 19th stock TV show, what do you call it? Stock Charts TV show, was this head and shoulder pattern on a monthly. Zoom out and you see more. That's all I'm saying.
Join Club to trade with Samantha. Scan this QR code or click the link in the description.